All right, looks like we're live. Welcome everybody to live valuation. I'm Midas and today we're going to be taking a look at ticker PATK, Patrick Industries. Definitely think this is going to be a pretty interesting valuation. I've done a lot of the numbers ahead of time, and I definitely am very pleased with what I've found and excited to share it with you guys. We'll see what kind of adjustments we make to the assumptions I've kind of already put in place, and who knows, maybe somebody will have something interesting to share on the subject that will change my perspective on it a little bit. But either way, we'll get into that, taking a look at our kind of general watch list that we have going on right here. I see some other companies kind of causing my attention from previous valuations. I've been kind of paying a little bit more attention to Smith and Wesson. That's kind of come further up in the valuation. We obviously have these other companies up here that are pretty high up, including Hovnanian Enterprises, Fair Expo, and Nerdy, all three of which I've done valuations on, but all three of them have kind of basket case issues. One of them being a really young growth company, so there's a lot of uncertainty with that. Another one being an iron mining company with mines in the Ukraine, so obviously big concerns there. And then Hovnanian, pretty default concerned company, so there's definitely a lot of issues and questions to be had on that one. So we'll definitely have to, I've been kind of ignoring those ones essentially, and then other companies that I've already bought, such as Hibbett, and the one it's already one of my main holdings on the channel. But Smith & Wesson's been kind of coming to my attention. I'm not going to be doing a new valuation for them until they release their 10K, which doesn't come out, I believe, until like May or June or something like that. So it's gonna be a little while until they actually update the 10K, but I have been kind of fidgeting with the numbers to see what I thought about the valuation. So this is still my best estimate of it, is that it's worth about $17-18 per share, while it's currently trading around 14. Makes it look pretty appealing. Not the most amazing return, but it's a high quality business in my opinion. So it's one of the reasons I've kind of paid attention to it. But anyway, I digress from that. We'll get into the company that we're kind of here to talk about today. We have our kind of general list of companies that we've been working our way through, and I'm definitely also excited to show my new screening spreadsheet that I built. I'll get into that after we get through the valuation today. But the screening method that we were using when we came up with this list, I kind of created a new spreadsheet. It's somewhat similar to the old one, but a little bit more cleaner, and hopefully something that other people will be more interested in using. Hey, how's it going, Evadors? Welcome to the stream. So getting into Patrick Industries, they are a pretty interesting building materials as well as electrical materials supplier for a couple specific sub industries. They have a large amount of their business is in the RV space, RV parts, as well as RV like wholesale manufacturing. That's the largest section of their business, but then they also have a few subsections of their business, including marine parts and wholesaling, as well as other industrial and manufactured housing sections. So it's a little bit of an interesting building products, home building mixed with some industrial and discretionary spending type stock. It's a very interesting company, and it's managed to have an incredible growth record over the last 10 years. So it's a very interesting set of financials considering the business that they're in, and definitely lots of questions and concerns about how well they're going to do over the next few years, especially with some of the economic concerns going on right now. So we'll see what we think about that going forward. But anyway, so we'll start off the valuation the same way we kind of typically look at them, which is taking a look at the segmentation and the risk building into the discount rate. And so as I was talking about, we have the different sections of their business. Almost 60% of the revenues comes from the RV section of their business, which I'm calling basically half auto and truck and half recreational. The marine and shipbuilding part of their business, which I'm basically calling half shipbuilding, half recreational. Manufactured housing, which I'm considering home building, and then industrial, which I'm considering kind of half building materials, half household products. So that's basically what we're going to consider their segmentation for their beta. Again, it's about 60% RV, 16% marine, 13% manufactured housing, and then about 11% industrial. So if we combine all those together, I end up with an unlevered beta for their industry of 0.97. And then they do have a pretty significant amount of leverage on top of that. So we'll see what that comes out to after leveraging it all up. The sales capital ratio for their industry comes out to an expected level of 1.55, so pretty decent as well as that goes, and a net margin expectation of about 10%, so also pretty decent as far as that goes. They have pretty high sales capital ratio themselves, though not quite as good margins on that level over the long run, so we'll get into that as well. The majority of their business is in the United States, about 91% of it by the operations of subsidiaries. They actually didn't provide the revenue base or asset based segmentation by geographies. Instead, I had to just go by the count of subsidiaries that they had. But they did, so they had one subsidiary in Canada, one subsidiary in the Netherlands, and then 2 in China, and then the rest are in the US. And so that's kind of my proxy for geographic representation for them, because they honestly didn't supply any other information for that. Either way, so it's mostly the United States business effectively. So anyway, getting into the leverage, as I was saying, 92% is the debt to equity ratio that I come up with, which gets me to a levered beta of 1.66. Hey, how's it going, GT? And so that comes off of the back of $1.5 billion in debt, lease, and lease liabilities at a weighted average maturity of about 5 years. So a decent, the first large chunk of their debts actually starts coming due in 2025 and 2026. Weighted average interest rate of 4.21%. So not a terrible interest rate, all considered. But yes, that's definitely a pretty significant amount of leverage. Yeah, thanks, GT. We broke through the 100 line and we just kept going all the way up to 109. This last week, we've actually had a pretty significant jump in subs. It's pretty awesome. Pretty good views overall on that. Also did a lot of other interesting things. In fact, while I'm talking about it, I guess I'll mention it here. If anybody who is watching on the replay after this, if you're watching at this point and you haven't been to the channel before, please do sub to the channel. We're trying to grow as fast as possible. Likes are also very, very appreciated by the current watchers and people on replay. I also want to point out that we are going to be trying to push the Discord channel a lot more regularly. The Discord link can be found in the description below. You should join it. We are trying to add a new little community on here for people to discuss company analysis, daily news. You can also share memes as well as videos on learning to invest, as well as there's going to be a link to a Google Drive that I have on here that I'm going to be sharing some resources for people to play with. There's a few PDFs or some investment writings, as well as a couple spreadsheet tools for people to play with. I'm going to be adding plenty of free resources on there for people, as well as I'll probably add some paid content on there over time. But right now we're definitely just trying to get more people to join the Discord. So if you're interested in that and you have a Discord, it'd be really cool to join that as well. So continuing with the valuation, as I was saying, with the pretty significant amount of leverage that they end up with, that gets us to a total cost of equity for the company of 11.73%, which is pretty up there, but nothing too shabby. A weighted average cost capital of 5.91% after weighing in the overall debt. Hey Tariq, thanks. I very, very appreciate the comment. It's pretty good to have new people on the show. Thanks for coming. It's giving you a little bit of a message on the long message. I think that's just kind of a default message. Don't have to take it necessarily too seriously, but either way, I appreciate your kind words. Welcome to the channel. So anyway, we'll look at the historical numbers for the company, which is pretty interesting for the last 10 years. If I come over here, just kind of scroll over, between 2012 and 2021, they went from $437 million in revenue to $4 billion in revenue. So they 10x their revenue in 10 years, which is just incredible. This is like a hidden growth story that I wish I had known about years ago. But it's pretty fantastic to see how much this company has grown, and we'll definitely get into the methods by which they've grown, because it's not exactly like this industry has grown at such a rapid pace. I'm sure it's had some decent growth over the period. In fact, we can get into some of the notes they have in their presentation on that fact. It definitely has grown over the last decade or so, but definitely not at the clip that this company is growing. Just off the revenue line alone, you can see for the first 5 years, they grew at a 30% compounded rate. 30% still as it rolled down to 26, 21, 22, and then in the last year they had a nice spurt, bringing the compounded rate back up to 27% for the last 5 years. So these upper 20s and into the 30s revenue growth rates for the last 10 years, yeah, just incredible, absolutely incredible. Gross margins not very high on this. I am using a little bit of an adjusted gross margin where I included some of their warehousing costs that they weren't including in their gross margins. I was including as part of their cost of goods. So the way I'm reporting the gross margin is actually slightly lower than somebody else might report it, but it's not a huge effect. Either way, same net incomes that you'll see other reported elsewhere. They have pretty low net margins on the whole of it. So it's like they're basically just a revenue growth story. This is not a high margin business. It's a relatively low margin business. But as I've kind of been talking to people a little bit more recently, in a few more valuations, so I'm kind of starting to focus a little bit more on low margins business. I think possibly some good opportunities for valuations is finding good businesses that have low margins, but it's not because they are in a poor business that they have the low margin. It's just it's like maybe it's a low margin business, but it's not because they have like outside pressures keeping their margins low. It's just a factor of costs and the overall scale. So what it does is I think it creates a large amount of leverage for a business, because if a business is operating in normal terms at 1 to 2% margins, well, it's much easier to go to a 3% margin or 4% margin than it is for a 5% margin business to jump to a 7% margin or a 10% margin. So if we're talking about like trying to get your margins to double over time, starting from a lower margin actually makes it much easier. So it's just strategic thinking that I've been kind of having lately. It's like the goal is to have a business that has a high amount of profits, but if you start with a business that has lower amounts of profits and builds into them, that might make it a little bit easier to find the undervalued gems in the first place. So either way, the point is I'm not necessarily overly concerned by their low margins. I'm actually kind of looking at that as one of the things that might be keeping the stock underappreciated in the general market. So if we come down to the cash flow line, this is one of the things that's very interesting about this. As you can see, they do acquisitions every single year during this 10-year period, and pretty significant acquisitions when you compare it to their overall market cap. Over the entire period, what is it, $1.8 billion in acquisitions over the 10-year period. If we compare that overall to the net capex that they did during the period, actually their net capex is negative, which means they had more depreciation than the overall capex that they did in their business. So their entire amount of actual capital spending, the growth that they've done in this business, has entirely been a function of the acquisitions. Again, so like $1.8 billion in acquisitions, and I mean, what's the gain in their market cap over the period? They had a $71 million market cap back in 2012, and they have a $1.5 billion market cap currently. So their market cap is currently a little bit lower than the total amount of acquisitions they did, but they've also come down in price pretty significantly. But you can see that basically their entire market cap has come, the growth in their market cap has basically just come off of the back of acquisitions, which is where they're getting the massive revenue growth in the first place. So that's part of the reason I wanted to really point that out. Not that that's a problem, it just shows that that's where their strength of business is that they have their margins. The margins aren't great, but they're solid. They're very consistent. You can see how consistent these margins are. Like the lowest margin on this 10-year period is 3.9%, and the highest is 6.42%, and that's the whole band, while the average comes out to 4.76. So it's very continuous and consistent margins. The most recent year is a little bit higher than average, but their 3-year average is not that different from the 10-year average. So you can see it's like very consistent margins, which I think is going to make it easier to predict them, moving forward. So taking a look at the overall cash flows, as we've talked about a few of our more recent valuations, that we've seen some overpayers to their shareholders over the period. You can see over the entire 10-year period for this company, it was an average of $26 million that they could have paid to their shareholders per year over this 10-year period, and the average amount that they actually did pay to their shareholders over the entire period was only about $12 million. So they haven't been overpaying their shareholders like some of the more recent evaluations that we've done. In fact, they've really only paid about half as much as they otherwise could have. They just started doing a dividend in the last couple of years, so it's a relatively small dividend, pretty much room to grow. And then you can see that when they've done their share buybacks, which is the only other form of capital appreciation that or capital return that they've done over the 10-year period, it's generally followed some pretty high cash flow years. Now, the one other factor that you could argue about this is that they have been issuing debt each one of these years as well. On average, they've issued $133 million in debt per year over the 10-year period, which is more than the cash flow that they had to avail to their shareholders, which means that they weren't taking out cash in the form of debt, they wouldn't be able to pay out cash to their shareholders. That's not necessarily a problem as long as you can keep paying it. But again, we already saw that they have a relatively high debt to equity ratio. So the concern for this company is not paying out to their shareholders, but the debt to equity ratio is still pretty significant. And that's really where the concern for the company is. So taking a look at what they've actually managed to do with this cash flow overall, we can see that the returns on invested capital they've had very strong, some 20 levels, but generally in these upper teens. It's kind of dwindled down a little bit in the more recent years to some lower teens, and then a single digit year in 2020 as well. Over the 3-year period, it's averaged about 11.5%. We take more of a 9-year compounding period over all the 10 years, it's closer to 15%. So we'll go ahead and keep the base at closer to the 3-year period, under the assumption that they've taken on maybe too much capital now, and now maybe the returns on the capital will be a little bit lower. But that makes sense. And you can see that the leverage that they've taken on has definitely given them good returns. They managed to get the returns on equity very, very high, in the 20s, basically across the board, except for 2020, with some numbers into the 30s, even the 40s at the very high level. Average for the last 3 years, 26%. So very, very strong. The leverage that they've taken on has been, again, significant, but it's actually managed to give them some real returns. And again, I think that comes off the back of how consistent they've managed to keep this margin. If this margin had been a lot more volatile and they'd had some loss years here and there and just some good years here and there, like a lot of the more discretionary spending companies, this picture wouldn't be nearly as pretty, because then they would have had to be factoring in those losses to their returns. So the leverage is significant, but it seems to be very consistent and well paced. And we already talked about how the average maturity is only about 5 years out, but the actual payments on those really don't start till about 5 years out, other than the lease liabilities. The lease liabilities are the only real major debt outflows that they'll have to make over the next 4 years or so. Taking a look at their balance sheet, you can see here, so this is the one that this part, as I was kind of already mentioning, is not quite as pretty. You can see their total current assets went from 74 million in 2012 up to 974 million in 2021. But comparing that against the current liabilities, went from about 29 million to 432. So overall, the current assets and the current liability situation has improved pretty well. But it's the longer term assets and liabilities that has gotten a little bit shakier over the period, going from 143 million in total assets to 2.6 billion in total assets in 2021. That's a pretty huge increase, so pretty much like almost 20x or so there. But the amount of liabilities have exploded pretty significantly as well. Only about a 10x, so technically the shareholders' equity has exploded more than either of them combined, which is generally what you want to see. Like I said, the returns on equity have been outstanding. It's just this growth in debt that's pretty significant. Again, up to about 80-90% debt to equity ratio. Again, it's not catastrophic. It's definitely not like a huge major default risk that you see in some other companies, like some of the like the actual home builders. I know, like for example, I was talking about Hope Nanny and Enterprises, which shows up relatively high on my watch list. It's pretty much at the top of the list for a while here, but its debt to equity ratio is insane, which is one of the reasons that it's trading as cheap as it is, because there's some serious default risk on that company. So while there is a decent amount of debt on this company, I wouldn't really consider it necessarily as huge of a default risk, though granted, we will adjust the valuation for that for the fact. So taking a look at the PE ratio that's traded over this 10-year period, that's another interesting factor. You can see that it has traded pretty much as low as it is right now. In other times in the past, it's currently trading at 6.88 as we're measuring it. It's had some definite cheap points in the past where it's traded like that, but you can see that it's also spiked up here into the teens and even to 20 at one of these year-end prices. So you can see that that has to do, I think, with the low margins with the potentiality of becoming slightly higher margins concept that I was sort of talking about a little bit before. It's that if everyone's pricing it like it's a low margin business, then it can occasionally surprise. And that surprise is going to give opportunities for it to spike up pretty dramatically, which could give opportunities to trim positions or to sell it entirely, depending on how long of a term of a perspective and how long you've held the position. So anyway, we'll kind of start looking into some of the analysis of the company. I'll start with the sales capital ratio over the longer term period. You can see it's also been pretty strong and consistent over the entire time frame, but it definitely looks like it's on a little bit of a downward trend over the time. There's definitely consistently in the 2s and even 3s and 4s in some of the previous period. They must have had a much smaller capital base relative to the sales, and then they started to build up their capital base to balance it out. So whether or not we want to think about like these most recent 3 or 4 years, or maybe the back half is the more consistent part of the business, if we take the average over the longer time frame, it's more like 2.76. Well, it's 1.91 for the more recent average. I'm inclined to use a more recent average just as a way of being conservative. So that's generally kind of what I've done. The expected ratio I currently have it is about a little over 2, with it being between 1 and 2.25. So I kind of have it leaned a little bit more towards the upper end, but with potential as if it going much lower. But that's just for the sales capital ratio. I did build a pretty interesting revenue model to kind of think about how we want to think about the different parts of their business and where it might go over time. So I will start getting into that, which there was some information in one of their presentations I kind of wanted to show as part of that. Let me make sure, find the right sections. You can see like one thing I want to point out, the different portions of their business in 2016 and how they've expanded over time. So the RV has expanded pretty significantly, but as a portion of their total revenues, it's gone down, which basically means that the marine the industrial and the manufactured housing have actually grown even more than the RV. In fact, they've absolutely exploded in their revenues, which we'll get into below. So they did provide some pretty interesting information that was pretty useful to look at as far as the 2016 numbers, all the way up through the most recent 12 numbers for each of those, as well as content per unit for parts of these businesses. I didn't really use the content per unit for projecting the different sections of their business or any of them except RV, since RV is about half of their business. I tried to be a little bit more accurate with that. But for the other parts of the business, we're really just kind of taking a look at their historical trends and thinking about where they can likely grow over time. But also I'll show what I mean with that. And then they did include, there was one line down here that was really useful I was going to use as part of my projection, which is that they have these favorable trends across the end markets that they're talking about, the boat ownership trends that they've seen over the last 5 years, as well as the RV ownership expectations over the next 5 years. They seem to be expecting about, what was it, 20.8 million RV people RV users and owners to exist in 2025, with potential for another 10 million or so in the next few years after that. I'm basically just running off of the 2025 numbers that they're using here and not really using the extra 10 million that they're talking about. But I do think that is a pretty good base point with which to start. So here's the model as I built it. They have, as I said here, the 11.2 million RV owners in 2020, and in 2025 they're expecting 20.8 million. This means over the 5-year period they're expecting a compounded rate of 16 to 17%. And so for the next 5 years, I'm assuming in the best case scenario that number is accurate and we see 16.74%. In the worst case scenario, I'm just going to assume that RV ownership actually drops off by about a 5% clip per year. A little bit of an arbitrary number, but I don't think, even if times are tough, I don't expect to see a huge drop off in RV ownership. I just think that the industry would stop growing. So by assuming any level of negative number, I think I'm already being reasonably conservative there. And then so for the total sales, you can see over the 5-year period, they grew at about 27% per year. Very, very significant growth, as we had already talked about. The RV part of their sales, the net sales from the RV business, only grew at about 9 to 10%. So this is what I mean, where it's like the RV part of their business grew pretty significantly, but that was not the growth driver, even though that's the largest chunk of their business. The growth driver for their business has been some of these other sections. Marine net sales, for example, grew at 56.6% per year compounded over the last 5 years, but only from 36 million, of course, to 339 million. So a very, very small portion of the business, but it's grown dramatically over the last 5 years. Manufactured housing also had a pretty significant growth, 22% or so. Industrial net sales grown 16 to 17%. So, but all three of these are definitely faster than the RV net sales, but definitely the marine one being one of the larger clip of the two. So I'm also assuming some pretty basic best and worst case assumptions for these. In the best case scenario, I'm assuming the marine grows at the same clip, which is a pretty strong assumption to assume that something grows at 57 million or 57% per year. But at the same time, most of this growth has come off of the back of the acquisitions. So this is part of the reason where I think that it's pretty reasonable to actually leave those assumptions in, because even if times are tough, they very well might be able to just acquire more business along the way. They've shown a consistent capability for that in their numbers. So it's a harder thing to predict, the ability to acquire new companies. That's a very, very difficult thing to project in growth. But considering how consistent it's been as part of their business, I think it's reasonable to assume, especially for part of that. But as a result of also assuming a pretty high level case for the best case scenario there, I'm willing to assume a pretty bad situation for that. Another reason why I'm also willing to assume the high level number for the marine net sales is because I think I'm being reasonably conservative in the RV portion of the business, which I did skip past. We'll get back to that as soon as I cover the other sections in completion. So housing net sales, I also do the worst case. Worst case scenario for marine net sales, I'm assuming negative 5%. You could also assume maybe it should be worse than that since I'm being so generous on the upper end, but yeah, it's only $262 million in total, so it doesn't really make a huge difference. I don't think that is a huge number necessarily to quibble about per se. And so I'm just gonna leave it negative 5%. So the manufactured housing net sales, I'm also assuming the best case scenario, it basically stays at the same clip, because again, these portions of the business have been done mostly through acquisitions. So I think it's reasonable to assume that perhaps they could actually keep acquiring smaller players within the business throughout the country at the same clip.
And worst case scenario, we're assuming it drops to 0%, which again, I think that's pretty conservative, especially considering where the housing stocks currently are. Even if we have pretty difficult portions of economic situation for the next couple of years, I think that the overall housing likely wouldn't slow down that much. It just might not become nearly as profitable off the back of inflationary pressures. So by using 0% here, I think I am balancing out the 22% that I'm using for the best case scenario. Industrial net sales, we're basically using the same logic across the board. It's increased pretty significantly. Acquisitions 0%, probably it could be a little bit lower, but could be a little bit less. I don't think it's necessarily too much. These are small portions of the business that doesn't require that much. Now, the main portion of the business, the RV portion of the business, like I said, I kind of skipped past that intentionally. I'm not doing it based off of the previous growth of the last 5 years, because this is the larger portion of their business. So I think it's a much more dangerous to use the same compounding number at that point. We got to use a little bit more of a careful number level, which is why I'm going to use the growth expectations of RV ownership that we had already used, as well as the content per unit growth expectations that we've seen over the period. The content per unit for the last 5 years has grown for them about 9 to 10%, which is roughly in line with the RV sales. So you can see that the RV sales growth for them, for the most part, has come in the back of content per unit growth. So if we assume that they can perhaps grow at that same level for them as well. Oh, actually, I see this is at 16, 17%. I don't think that was. Oh, that's right. I had it set to the RV ownership. So if we assume that perhaps the content growth grows at the same level as the RV ownership in the best case scenario, and the worst case scenario grows at 0%, which I think is extraordinarily unlikely in the inflationary environment that we're in, that gets us that particular level as well. So if I combine those two compoundings together and multiply them against the total sales for RVs, that gets us a best and worst case scenario for them of 3 billion and 1.3 billion. So if I add up all the best and worst case scenarios across these different models that I put together, I end up with a best case scenario revenue for PATK Industries 5 years from now of 8 billion or so, and a worst case scenario revenue for them of 2.4 billion. Using those numbers, I've actually put them already into the model. You can kind of see here. That gets us a compounded growth of negative 10% to positive 14.5% on the best case scenario, and that's our spread of revenues. I did put basically the midpoint between the median case and the more optimistic case, sort of a midpoint, a little bit trailing, a little bit higher than that, 5.7 billion. We can actually maybe adjust that if necessary, as kind of my midpoint between these, and that gets me an expected value of about 5 billion as sales 5 years from now. So that gives us an expected growth of 4.5% per year. Now, for the last few valuations, I've also used kind of an average of the last few years for revenues as a base, on the assumption that a lot of these companies would have a drop in revenues in the next most recent year, because a lot of companies have lowered their guidance in the last few weeks and months. But if you take a look, for example, at PATK Industries on Yahoo Finance, the coverage that's being done on here, there is actually expectations of growth for them in this next year, partially because they are already doing some acquisitions, and there's already been some announcements on that front on their corporate webpage. So there's actually some pretty significant growth that's already being priced in this year, and our valuation is definitely, for the most part, not really taking a huge portion of that into account. So I definitely think in using a sandbag level for the base year of revenues is definitely not appropriate in this current case. In fact, if anything, I'm probably undershooting the revenues, possibly a certain portion, at least on my expected case, definitely for the next most year, but perhaps not for the 5 year forward period. So either way, the point is I definitely think that the revenue model is pretty decent, based off of the assumption that there's already expectations that they're going to have an average estimate of revenue of 4.74 billion in 2022 and 4.5 billion or so in 2023. So in 2023, people are seeing 4.5 billion, while my expected or my average, at least without the expectations, comes to 4.3 billion. The expected level I have for 2022 is 4.2 billion versus their 4.7. So I'm already sandbagging the near term revenue numbers on the assumption that I think my projections for the future are pretty reasonable. So with that, I did actually weight the revenues pretty far forward compared to a lot of our valuations. We usually have the most of the weight in the middle case, but I actually have a pretty decent amount of it weighted into this 8% model, which is part of the reason, like I said, I do think that the revenues, I'm weighing in some pretty worst case scenarios, but I honestly think the upper optimistic ends of this model make a lot more sense and are actually closer to the truth than otherwise. but I needed to kind of weigh in some worst case scenarios this particular way. So I kind of did this, tried to do the same thing across the board for the various other metrics. You can see for the margins, we did sort of a similar thing. I'm expecting perhaps like a 4.5% margin over the time frame, maybe slightly higher. We left some room for it to grow pretty significantly, but we also weighed in a pretty significant chance that it falls essentially between these two levels. As we had said before, the margin has potentiality to jump in some specific years, but in general, it's actually pretty strong across the board. And moving down the line for the sales capital ratio, I did already cover this a little bit on the at this a little bit earlier portion of the stream, but the sales capital ratio has been pretty strong over the period, but we have an expected level of around 2. Thanks, Jack. Yeah, pretty exciting to have hit 100. Now, if we could just get another 900 or so, and I could start getting monetization on YouTube. Long way to go for that hurdle, but one step at a time. With 3 digits is pretty satisfying. So either way, with the assumptions already in place, like I said, this is I kind of did a lot of the work ahead of time on this one and felt pretty satisfied with most of the assumptions in place before I started the stream. The only thing really that I didn't adjust was the default risk as per normal, which I can kind of do right now real quick. The perpetual debt levels that we'll see for them across the board is going to be in general way more than they'll have cash on hand. Again, they have a pretty significant amount of leverage. Even in good times, that's just kind of their business model for good or bad. So we definitely have to weigh in some considerable default risk. Let's see, put that in right now. 2.47. Okay. Yeah, so in some of these worst case scenarios, it definitely starts to become a more significant chance. So about 2% or so chance of default in any given year, depending on if capital markets are essentially available to provide them the cash flow they need. And that's essentially what the default risk is about. It's not so much about whether or not they can't pay their debts. It's about whether or not they can roll over their debts. That's really the issue at hand. It's about whether or not capital markets are available to offer them new debt because of the fact that they've been relying on it. So anyway, we can kind of take a look at the summary. It does basically come to an overall summary for PATK, Patrick Industries. The 10-year treasury is currently selling for just under 3%, 2.9% or so. I think it might have dipped into 2.8% or so today, but this is usually about 1 day behind the import for this number. Mature market equity risk premium I have is 5.22%, so pretty solid equity risk premium that we've gotten to, especially considering that the treasury is now getting close to 3%. So overall, the discount rate on the S&P has grown to a pretty significant level. The discount rate I come up with for Patrick Industries after adjusting for company-specific risk is 11.72%. It is on the back of the leverage that they have, as we kind of already noted, but overall, it's a pretty good discount rate to have in place. It definitely makes me feel pretty satisfying about the overall expectations for the future. And the dividend that they have is 2.1%. I'll explain the default risk after I finish this summary a little bit more. Just give me a second. So 5 years ago, they had sales of $1.2 billion, and then they grew to about $4 billion in the most recent year, which is a sales growth of 27% for the last 5 years on a compounded rate. Very, very significant. Sales capital ratio they had in the most recent 3 years on average is 1.91%, or not percent, 1.91 against industrial expectations we have of 1.55. So they do have a little bit of a better capital expenditure ratio than their industry expectations. Returns on invested capital has been 11.5% or so on average for the last 3 years, and their current debt to equity ratio is about 92%. The default risk in the most recent year has been a little over 1%, not too significant for the most recent year, but that's just the most recent year. The profit margins for the last 3 years on average has been about 4.5% against industrial expectations of about 10%. So they've done a little bit better in their capital ratio overall than their industry, but they're not as great on their margins. But overall, the market has appreciated that in keeping their relative multiple low. Their present price that they're selling for is $64.65. The probability distribution that we're using for the company is pretty heavily tilted towards the more optimistic fourth model against the median case third model. This has to do with the fact that we're really trying to weigh in some worst case scenarios against what we think is actually more likely optimistic scenarios considering their history. But we do have to weigh in those potentialities because there's a lot of risk in this more discretionary spending level stock. But that does get us revenue expectations of anywhere from 2.4 billion in the worst case scenario to possibly 8 billion in the best case scenario. We see 5 billion or so as an expected value. That gets us sales growth of negative 10% per year for the last 5 years to possibly positive 14.5% On an expected basis, we see 4 to 5% per year. The sales to capital ratio is about 2% on an expected basis, and the returns on invested capital is about 9 to 10% on an expected basis. Hey man, I did cover all of the history earlier in the stream already. It's fine if you just showed up, but you could scroll backward and see the earlier part of the stream when I already talked about it. Just saying. I might cover that afterwards too, but just it is worth noting that I did already cover all of their history. The debt to equity ratio that we have on an expected basis for the company is 105, 106% for the company. So we're assuming that perhaps they do have to take on a little bit more capital, or perhaps their market cap comes down more significantly in the next 5-year period. In fact, that's probably the more likely situation, because I don't necessarily want them to take on more capital per se, even though they very well might. That does give them a pretty significant default risk, which comes out to about 2.2% over the next 5 year per year. I know, I assumed as much. I'm just giving you shit. Like I said, I'll cover it a little bit more as soon as I finish with this. Profit margins, I have in a range of about 1% to 7% as a distribution. I'm seeing about 4.7% as an expected value, and that gets us profit expectations 5 years from now of anywhere from $24 million in the worst case scenario to 562 in the best case scenario, which gets us 240 on an expected basis. So with the discount rate that we assign to the company and the various debt to equity ratios, that gets us a present value price expectation of $77.10, which is 19% higher than the current share price. The 5-year forward value targets, unadjusted for the dividends that they'll pay out during the period, gets us a worst case scenario of $16.36 in 5 years to a best case scenario of $313.11 in the best case scenario. On an expected basis, I see $134.16, which compared to the current share price of $64.65, that gets us a compounded return expectation for the next 5 years of 15.72% per year, which is pretty awesome, pretty significant. And if we include the short-term pricing metrics, which is a regression of current market multiples like PE, price to books, price to sales, EV to capital, and EV to EBITDA, and output it against a regression of expected multiples from the S&P 500 based off of certain fundamental metrics like margins and growth rates and stuff like that, we actually end up with an expected price for the stock of $151 compared to the multiples they're trading at, because they traded at extraordinarily cheap multiples next to the market, which is much higher than even my expectations here. But this is generally a multiple based kind of short-term icing on the cake kind of methodology. Again, cash flow methodology is a little bit more of an accurate measure for a long-term investment. So 15-16%, definitely nothing to sneeze at. Very, very good returns. I'm definitely very, very interested in this company. The value score I come up with is not very super high. It's not bad either, 0.92, but it's not over 1, which is generally the point where things become a little bit more interesting to me. But this one's actually kind of standing out a little bit more of interest to me because of the consistency of their margins. I definitely like that, as well as how well managed their cash flow seems to be by their business, and the fact that they're not overpaying their shareholders and stuff like that. So we'll definitely take those things into account. So now let me get into some of those questions you were having. The other question, if you have time, how does the model discount, how's your model discount significant or non-existent book value? It doesn't really take book value into account for the most part, because the discounted cash flow is about the cash flow you're going to produce, while your book value is about the fact that you haven't made profits in the past. There's very, very few aspects about the balance sheet that is really relevant to discounted cash flow valuation. That's more of like things that you have to kind of think about in terms of what happens if the cash flow doesn't start coming in. It's like that's not so much about I mean, it's indicative. It can be useful as to painting a picture to give you an idea of what they've done in the past, but it doesn't necessarily tell you anything about the future, because that's all book value is. Book value is just a receipt, effectively. It's a very complex receipt. So if a company has negative book value, for example, like I've talked about that on my streams many times, and I'm usually I usually try to paint a very, very careful picture of companies that have negative book value, or especially negative retained earnings, and that being the thing that's contributing to their negative book value, or if they have too many share buybacks, and that being the thing that contributes to their negative book value, but it doesn't necessarily affect their cash flows. If two companies had the same DCF forecast, but one had a bunch of net cash, would your model discount that?
it would already be implied in the model. Here's how that would be different, because for example, I know, for example, me and you have talked before about the difference between equity valuation and firm valuation, where a lot of people, what they do is they project operating income, a post-tax operating income, and then they use the operating income, or not post-tax, but it's not even post-tax, my bad, pre-tax operating income, and then they project that out for 5 years, and then they discount all of that back at a cost of capital rather than a cost of equity, which I have both right here. You can see the weighted average cost of capital is like 6%, while the cost of equity is like 12%. So notice the big difference in those percentages. So they project out a operating margin, which is usually higher than a net margin. The higher number gets discounted at a lower discount rate, and then while the lower number gets discounted at a higher discount rate. And so the number that ends up at the end of the net margin that's being discounted at a cost of equity discount is going to be lower than the firm value operating margin that's discounted at a weighted average cost of capital. And then what they do after the fact is they take the firm value, which has been discounted at the weighted average cost of capital, and that's when they add the debt on and subtract out cash. Whereas what I do is instead, I don't add in the cash and subtract out the debt, but instead what I've done is I've taken into account the debt to equity ratio that they have here, which is what this whole section of my spreadsheet is about. So when I say on this spreadsheet right here that it's the debt to equity ratio is this range of anywhere from 175% to 50, on an expected basis, I'm seeing 105%. That means that for every amount that their market cap grows, I'm assuming that they're going to take on a certain amount more debt, and that debt is going to imply a certain amount of payback based off of the interest rate that you've applied to them. So the fact that I'm using a net margin versus an operating margin versus another person's discounted cash flow that might be using an operating margin, but then have to add on the debt and subtract out the cash. Yeah, so it's like the way I've already adjusted for the amount of cash a company has or the debt that they have, I've covered in this debt to equity ratio, because what I'm doing is I'm basically like deciding, it's like, that's what, because I have the sales capital ratio here. So I have sales. First, I decide how much sales that they are going to grow. First, I decide how much is the company going to grow. And then I say, okay, to grow, you need to add capital to the business. And that's why I use the sales capital ratio, because first I decided how much sales I'm going to use. And then, but based off of how much sales I need, that decides how much more capital I need. And then after I've decided how much more capital I need, I decide, okay, where am I going to get the capital? Am I going to get it from debt, or am I going to get it from equity? And so based off of how much capital I've decided I needed, I then decide how much of it I'm going to use in the form of debt. And then whatever's left over is the equity. And then based off of how much debt I've used, that's when I assign how much risk there is to the debt, because if you're going to take on more debt, you have to be able to roll it over every few years, or you have to be able to pay it down. And both of those come with risks. So we assign some risk to the debt that we take on. And then the profit margin, like I said, I'm using a net margin. So the net margin is below the interest costs. So I have to take into account the fact that they have to pay interest costs on their debt. And so another person's valuation, where they would add on the cash to the valuation, they wouldn't be using a net margin. They would be using an operating margin, which is pre-interest taxes, interest and taxes. And taxes, because taxes are affected by your interest payments, so you have to use them together. Yeah, so yeah, it's just two different ways to do DCF. I know we had discussed this month before over a Discord call. I wasn't sure for how, sometimes you have to hear the same explanation a few different times, a few different ways, and I'm not always great at explaining these things. But yeah, so it's like you don't have to account for book value, because it's already accounted for, sort of. If they need to add more capital to their book value over time, that should show up in the debt to equity ratio, effectively speaking, or it should show up in lower margins, or both, some sort of combination between the two. So anyway, we'll move a little bit past that. I did get your message talking about Zoom. I was going to kind of mention a little bit about that with whilst talking about this new spreadsheet that I put together. I put together a new kind of a screen tool. It's very similar to the other spreadsheet I was using for screening, which was a little bit more than a screen. It was more like a quick and dirty kind of relative valuation tool, where I just put in net income and the growth rate a little bit, and then I use the multiple to kind of like get an idea of what the companies were. And this was one of the ways I was using to screen things. But I did put together, I was trying to put a new one together over the weekend that I think I might be willing to share with people over time.
So people who have joined the Discord will be able to get access to this. So this should be one thing to incentivize people to join the Discord. It's not already in the Google Drive link, but it will be probably after this stream. While there is a couple other things already in there. And at some point or another, if we get more people in the Discord, I will probably eventually start charging people for a couple of these tools if I start adding new tools over time. So the people who get them into the Discord first get them for free first, just for being the first people in the Discord. So no decisions on what number that is. Maybe it'll be the first 20 people in the Discord. I don't know. Maybe first 30 or whatever. No real rules on that yet per se. But either way, point is if you like what you see, you can use it here. So basically what it is, it's really just this one page little tool. You can put in all the information in these yellow columns. All the information is designed to be gotten off of Yahoo Finance, so you really only have to go to one place to get all the information. And you can come up with a kind of a quick and dirty, relatively simple way to get an idea of valuation in the terms of the way that I talk about it, as well as looking at some other factors. This group of companies right here is the companies that we've kind of already covered on our channel a little bit. We can I kind of wanted to show them off. You can see, put the sales in here, you put R&D costs if they have them here, net income here, cash balance, total debt, and book equity here, so that we can figure out the debt to equity ratios, as well as the sales growth expectations for the next 2 years and the EPS growth expectation for the next year. I'll show that off of Zoom, for example. Like I said, I did kind of pull that up to look at. I'll show where you can find all this information. All the information can be found on the financials page here, with R&D generally showing up in the operating expenses if it exists, and net income showing up here. Then on the balance sheet is where you can find the total debt down here, as well as the book equity listed here. And then for cash, you kind of have to click into the current assets a little bit to get to the cash and equivalents. And then generally speaking, I recommend people only do the cash and equivalents and not other short-term investments. If you need to understand why that's a risky thing, take a look at what's happened to bond prices over the last 3 to 6 months, and maybe you'll understand why it's risky to include short-term investments as cash, because sometimes you end up with 5 to 10% less of them than you think you have. So I only count actual cash and equivalents personally, but that's up to the person to decide what they want to do. As well as then the growth numbers is on the analysis page. You can see the revenue growth numbers are listed here for the next 2 years, so you can put those in, as well as the EPS growth rate expectation for the next 5 years is listed down here. For any of those numbers, obviously you can do whatever you want. You don't have to get them where I got them from, and you can choose to put in whatever assumptions you want. That's just how it is. I do have this instruction page giving you relatively detailed instructions on where, like I said, where these things come from, where to put them, specific hints of what not to do, which you can see is listed in red. What not to do is basically to mess with anything on the calculation page or the import page, unless you really think you know what you're doing with spreadsheets. The entire operation of the page is just on this input output page. How to and input output. That is the entire thing. Okay, just so everybody knows. So obviously I put in all the stock tickers here. It gives me the price, gives me the market cap, gives me the distance it is from the 52-week high. So I can see that Hibit's down 55% from its 52-week high. I can see that Ruger's down 25% from its 52-week high. Net margin we have listed here. This is the reported net margin. So this is a GAAP-based net margin, a PE ratio based off of GAAP earnings, as reported by the numbers that you put in here. And then I use an adjusted margin and an adjusted PE, which is me adjusting for the R&D costs like I typically do on my streams. It's an estimation. It's not exactly what I do on my streams, but it's an approximation that should work for most companies. So if you like my methodology of an R&D adjusted capitalization method, and you think that margin makes more sense, then I would go with that. And that's the reason why I also have it on here, even if you may not care for it, is that is what I'm using to come up with the fair value estimate that I have over here as well. So either way, it's being used. Then I also do have the price to sales ratio, which I've criticized a lot on my channel as being a very risky measure to use because it doesn't take debt into account. So that's why right next to it, we have the debt to equity ratio. And then I also have the EV to sales ratio, which is a ratio that corrects for the debt to equity ratio on a price to sales. So I have those relatively side by side, but they're there. Then I did include the sales to capital ratio, since that's another thing that I think is important to look for when you're trying to analyze companies, as well as an estimated return on invested capital over the last 12 months as well. And then, like I said, I did come up with a fair value estimate. So it's an approximation of what I do on my channel here with the fair value. It's definitely not not exactly accurate, but it's relatively kind of close to at least the idea. It's like I said, it's the same methodology I use for trying to decide what to look into more. This should not be used as something to like make your only investment decision. But if you're trying to look through several companies in a sector and you want to compare them next to each other, or if you just want to look through like the financials of 20 companies really quickly, this is a way you can kind of take a good look at a company with only a handful of metrics that you need to get together. And then down here, I did actually put together some charts, some little graphs of these numbers. You can see PE ratio graphed against the distance from the 52-week high. And then there's also market cap graphed against the PE ratio, as well as the adjusted PE versus the adjusted margin, as well as an EV to sales versus an estimated return on invested capital. For pretty much all of these, you should generally expect to see a trend correlation up as PE ratios go. Well, not for this one. This one's a 52-week high, so that one's kind of depends on what's happening in the market. But that can give you an idea of what's cheap versus what's dropped most recently. Versus this one, as market caps get higher, typically they have higher PEs. So if a company's smaller, you would expect it to have a smaller PE, and that's one way you can kind of take these things into account. Adjusted PE to adjusted margin, you should also generally expect a higher margin for a higher PE stock. Not always perfectly one-to-one, but there's generally a trend that way. And then EV to sales, there's generally higher returns on invested capital. If you have higher returns on invested capital, you're generally given a higher EV to sales. So these are just some charts to help you kind of maybe take an idea of how good a company is on some of these multiple base metrics versus some other factors that are important when comparing them. So anyway, like I said, this is a tool that will be available on the Google Drive link in the Discord link. Or in the Discord server, which the link to that itself is found in the description below. So if you want access to this, that'll be available for all of the early members to the Discord server over the next, I don't know, however long it takes to get a decent amount of people showing up in the server. So with that, like I said, I will probably put Zoom into this grouping at some point over the next few days. I'm not going to do that now. I'm probably going to close up the stream here. But that is basically the new thing that I wanted to show the viewers. Like I said, a little tool I wanted to provide people. People have kind of been asking for some spreadsheet tools from me, so I wanted to start trying to provide those. Though, like I said, I want to sort of get something out of it. So what I'm getting out of it is Discord memberships in the near term, and then over time, eventually, once we get maybe even some more subscribers, hit maybe 150, 200, maybe we'll start charging newbies a few bucks for access to some of those tools. So with that, we're going to be bringing the stream to a close. If you haven't already liked the stream and you enjoy content like this, please do like it. We'd be very much appreciated. If you're watching on replay or you haven't already subscribed to the channel, please do subscribe to the channel. We'll get notifications when I go live, as well as when I provide other investing videos. On that note, I did put out a video on my favorite investing books. If you haven't checked that out, that could be of interest for people who want to get an idea of some of my favorite literature on investing, as well as you can see here on our watch list, we're looking to take a look at LPX is possibly the next company I'm going to be taking a look at on Thursday. So I'll catch you all again on Thursday.